price doesn't move in straight lines, the institutional mechanics behind impulse and corrective moves. Introduction. Good traders often ask, why doesn't price just go straight to its target? At first glance, that seems like a reasonable question. If smart money knows where it's going, why all the zigzags? Why the corrections? Why the traps? The answer lies in the structure of liquidity, the nature of institutional trading, and the necessity of rebalancing inefficiencies in a fragmented global market. 1. Fundamental reason. Liquidity is not distributed in a straight line. The market is not one large pool of capital flowing smoothly from one place to another. Instead, it's a series of fragmented pockets of liquidity sitting at key price levels. Smart money cannot simply place massive orders and expect instant fills. If they did, it would move the price unfavorably and alert the entire market. So what do institutions do? They build positions in pieces by creating impulsive moves to generate momentum and sweep stops, corrective moves to return price into areas where more orders are waiting. Thus, the zigzag movement isn't inefficiency, it's precision execution. 2. Impulse move, purpose and mechanics. What is an impulse move? An impulse move is a strong directional burst in price driven by institutional execution. This is when smart money reveals its intention, usually after accumulating a position. Why it happens: to shift market structure, to displace price away from equilibrium, to create a fair value gap FEG that proves an imbalance, to trap traders who enter late and get stuck at bad prices, to break key levels, support resistance trend lines. Purpose: reveal institutional interest, but only temporarily, confirm break of structure, BOS, induce emotional participation from uninformed traders, mark the beginning of the next leg in the market cycle. Think of the impulse move as the power move, a strategic punch from smart money that creates psychological and structural shock. 3. Corrective move, purpose and mechanics. What is a corrective move? A corrective move is a counter-trend retracement that typically follows an impulse. It doesn't indicate a trend reversal, rather it's smart money's method to refill orders, manipulate retail traders, return to areas of imbalance, OB, FVG. Why it happens: price must rebalance from the previous impulse to return into fair value gaps or test unmitigated order blocks, to create inducement setups, false hope for retail, to trap liquidity resting above below recent highs, lows. Purpose: allow smart money to re-enter positions at better prices, correct overextension caused by the impulse, push price back into liquidity zones, signal upcoming continuation or reversal with structure confirmation. Correction is not weakness. It's the institutional reload, a calculated pause that separates the amateur from the professional. Why this pattern must repeat: markets breathe. They expand impulse, then contract correction, just like lungs inhale and exhale. Here's the reason this structure is necessary: dynamic, impulse, correction, speed, fast, slow, volume, high, lower, structure, breaks previous levels, retests or pulls back, psychology, excitement, panic, FOMO, doubt, fear, confusion, institutional activity, execution begins, orders are filled/added. Without this structure, price would move irrationally. There would be no entry points, no liquidity, and no efficient market. Nash 5-5, real example. Applying the logic, let's say price sweeps a double bottom, liquidity grab, a strong bullish order block forms, price explodes upward, impulse, retail buyers enter late N. Now what? Institutions want to trap late buyers, re-enter long positions at cheaper prices, close some positions partially, so price corrects back toward the order block, the 50 to 78.6% Fibonacci zone, the fair value gap left behind. Once price rebalances, the next impulse begins. 6. Summary for retention. Price doesn't move in a straight line because Liquidity is distributed unevenly. Institutions build positions gradually. Price must correct inefficiencies created during impulse. Psychological manipulation requires both expansion and contraction. Impulse move equals institutional intent. Breaks structure, leaves gaps, shifts sentiment. Corrective move, institutional reset, rebalances price, creates better entries, tests market reaction before continuation. Final thought. The market moves in waves not because of randomness, but because smart money breathes in cycles. Accumulate, drive, correct, repeat. Those who understand this rhythm do not fear pullbacks or chases. They wait for structure, confirmation, and logic, not emotion. Thank you for watching my video. If you found this content helpful, don't forget to like, subscribe, and hit the bell icon so you never miss an update. Your support means a lot, and it helps me create even better content for you. See you in the next video.